What if the exact trading pattern your favorite textbook told you was, a guaranteed buy signal was actually engineered by a multi-billion-dollar bank specifically to take your money?
Yeah, that is the uncomfortable reality, isn't it? Because the charts that intermediate day traders are just staring at every single day, they're essentially digital battlegrounds.
Right.
And if you don't really know how that battlefield was constructed, well, you are highly likely the one providing the ammunition for the other side.
Which perfectly brings us to our mission for you today.
Hmm.
Because, you're not a beginner anymore. You know your way around a candlestick chart. You understand support and resistance. And you've definitely experienced that incredibly frustrating moment where the market just seems to, like, hunt your stop loss.
Oh, yeah. Every trader knows that feeling.
Right. It clips it by a fraction of a pip and then instantly just runs in your predicted direction. So today we are taking a really massive stack of notes and transcripts from the Inner Circle Trader Mentorship,
Hmm.
often just called ICT. And we are going to use them to decode institutional order flow. We're doing a full deep dive to just completely flip the script. The goal here is to help you stop trading like retail prey, I guess, and start seeing the market through the lens of smart money.
Yeah, and to actually do that, we have to start by recognizing that the market it's not just this random walk of chaotic buyers and sellers.
It feels like it sometimes.
It does, but it's really a highly efficient engineered mechanism. And it's designed to do basically one primary thing, which is seek out liquidity. The massive institutions, the central banks, the major funds, they actually leave very specific footprints when they execute their trades.
Okay, so let's start hunting for those footprints. Because looking at the ICT materials, they suggest that the absolute biggest mistake intermediate traders make is, well, developing tunnel vision.
Oh, absolutely.
Like, you pull on a chart of the British pound, you stare at it for hours, and you just base your entire thesis on that one isolated data feed. But the sources argue that you really need to understand what they call institutional market structure.
Right.
And that means taking a huge step back to look at how correlated assets move together, right?
Exactly. The foundation of that structure, especially if we're talking about the foreign exchange market, is the US dollar index. So smart money, they never look at a foreign currency like the British pound or, the euro in a vacuum.
Because currencies are traded in pairs.
Right, like the pound against the dollar. So the dollar index acts as this ultimate underlying barometer. In a perfectly symmetrical market environment, these assets should move like a mirror reflection. So if the dollar index pushes up to a higher high, it exerts downward pressure on foreign currencies. So logically, you'd expect the pound to make a lower low.
I always kind of picture it like a seesaw on a playground. If the pound side of the seesaw is going way up in the air, the physical mechanics demand that the dollar side is going way down.
Yeah, that's a great way to visualize it.
But the sources actually highlight this massive anomaly from June 2016 involving the pound, which traders often call the cable and the dollar index. In this specific window, the pound made this massive, just beautiful, bullish, higher high on the daily chart.
It was textbook.
Yeah, to any retail trader, it looked like an absolute undeniable breakout.
But the bizarre thing about that breakout, and this is where it gets interesting, is what happens when you overlay the US dollar index from that exact same time period.
The symmetry totally broke.
It broke completely. While the pound was making that higher high, the dollar index actually failed to make a corresponding lower low. Instead, the dollar made a higher low. And this is a core concept the sources call SMT divergence.
They're more money technique.
Exactly, SMT divergence.
So going back to the seesaw analogy, the pound goes up, but the dollar just flat out refuses to drop.
Right.
Which is physically impossible unless, someone incredibly heavy just quietly put their foot on the dollar side of the board to hold it up.
Right, they're stepping on the scale.
So if retail is rushing in to buy the pound breakout, what is smart money actually doing with the dollar there?
Well, that broken symmetry tells us the dollar is being quietly but very aggressively accumulated.
Wow.
Yeah, large institutions are basically building this invisible wall of buy orders. They simply refuse to let the dollar drop to a lower price because they are just scooping up every single available contract.
Oh, I see.
And consequently, that beautiful upward breakout on the British pound, it's completely artificial. It is a trap.
So they literally engineer a fake rally on the pound just to lure retail money in.
They absolutely do. And SMT divergence is basically the X-ray revealing that manipulation to you. By monitoring the underlying strength in the dollar index, a trader would know immediately that the pound's breakout lacked true macro participation.
Right.
It was really just a mechanism to gather up retail buy stops above an old high before the smart money aggressively tanks the market.
Okay, wait, but if they're secretly accumulating the dollar, why even bother letting the pound break out in the first place? I mean, why not just crush it immediately?
Well, that leads straight into the core philosophy of these ICT notes, which is the market efficiency paradigm. It really all comes down to scale.
Scale.
For sure.
Because a retail trader can just open their brokerage app and execute, a 10-lot trade instantly without moving the market a single pip.
Exactly. But a major financial institution trying to build a multi-billion-dollar position, they face a totally different physical reality.
Right.
If they just dump their entire order into the market all at once, they will literally absorb every available bid and completely ruin their own entry price. They need an equally massive pool of willing counterparties to actually take the other side of their trade.
Which means if a massive bank wants to buy, they have to find someone willing to sell to them at a discount.
Yes.
And as an intermediate trader, you already know about stop losses. But what genuinely shocked me in these notes wasn't just the fact that stop hunting exists. It was the absolute, just ruthless precision with which market makers manipulate price to create what they call liquidity pools.
Yeah, it's very systematic. Think about the sheer volume of orders resting just below a really significant, obvious low on a chart.
Everyone puts their stops there.
Exactly. Retail traders are uniformly taught by conventional wisdom to place their protective sell stops right there. So when an institution needs to buy heavily, they deliberately, just temporarily, drive the price down through that old low.
To trigger the cascade.
Exactly. This artificial drop triggers a massive cascade of retail sell stops.
It's like, I was thinking about this, it's like the market makers are playing a chart-wide game of Pac-Man.
Oh, that's good.
They aren't trying to predict where the price will, organically drift. They're actively navigating the chart to eat the biggest, densest clusters of dots, and those dots are our stop losses.
That is exactly what they're doing.
So when a retail trader's stop gets clipped and they are forced to sell, they are literally handing their position over to the smart money at wholesale prices. Getting stopped out wasn't bad luck.
No, not at all. The institution uses the retail trader's pain as their entry mechanism. It's their business model. And this physical reality of order flow introduces a really critical technical rule for reading candlestick charts.
Okay.
You have to separate the wicks from the bodies.
Yeah, I want to spend some time on this actually because it challenges pretty much everything you learn in standard technical analysis.
Yeah.
Usually, you draw a line at the absolute lowest tip of a candle's wick and you just call it support. But institutional order flow says those wicks are basically just noise.
Yeah, the wicks are, they're like the vacuum cleaners of the market.
Vacuum cleaners.
Yeah, they represent sudden influxes of retail emotion, maybe broker spread manipulation, and exactly those engineered stop hunts we just talked about.
Right.
Institutional volume, the genuine massive interbank pricing that actually sustains a real market trend that is found in the thick bodies of the candles.
So the body is essentially the floor, and the wick is just this exploratory probe dipping down into the basement to steal liquidity.
That is exactly how you should visualize it. When you watch price approach an old low, you will so frequently see a long, aggressive wick pierce right down through it, triggering all those sell stops.
Mm-hmm.
But when the candle actually closes, the thick body remains safely above the old low. The wick did the dirty work, right? But the institutional money never actually committed to breaking that structural level.
Okay, but if these patterns of manipulation are so consistent, how is the retail crowd continually lured into providing this liquidity? I mean, they can't just be randomly placing trades everywhere.
Well, they're not. And the notes point the finger directly at the classic retail patterns taught in every single beginner trading book.
The textbooks are the trap.
Exactly. It turns out those patterns are the bait. For instance, the sources refer to diagonal trend lines as trendline phantoms.
Trendline phantoms.
Yeah. Retail traders are totally conditioned to draw these perfectly sloped diagonal lines connecting higher lows, genuinely believing that a third touch on that line offers guaranteed support.
Oh, we've all done it. You see a beautiful channel forming, you wait for the price to drift down to that diagonal line, and you just buy it. It feels so safe.
Right, but the issue is that banks place absolutely zero value on diagonal lines.
Yeah.
None. Institutional algorithms operate on horizontal liquidity. They care about the physical orders resting above specific numerical high and low price points. Therefore, a perfectly painted diagonal trend line is very often carefully constructed by a market maker to act as a brilliantly disguised trap.
So they basically let the price bounce off the diagonal line twice to build confidence, luring all this uninformed retail money into the market.
Yeah.
Retail traders pile in, they feel safe, they tuck their stop losses just under the trend line, and then the market maker just unplugs the machine.
Exactly. Price collapses, it sweeps all that horizontal liquidity sitting under the diagonal line, and smart money just absorbs all those orders.
Yeah, it is brutal.
And this trap extends to far more complex geometries too, specifically the head and shoulders pattern. The notes break down a perfect example of this on the August 2015 British pound hourly chart.
Right, the head and shoulders. I mean, that is arguably the holy grail of retail topping patterns.
Yeah.
You have a peak, right, a higher peak for the head, a lower peak for the right shoulder, and then a horizontal neckline connecting the lows. And the textbook says when price breaks below that neckline, you short the market with everything you have.
Oh, and the banks know that textbook inside and out.
Right.
In August 2015, they allowed a pristine head and shoulders to just form beautifully on the hourly chart. When the price finally broke down below the neckline, retail traders rushed in. They were aggressively selling short, completely convinced that a massive crash was imminent.
But if they just zoomed out to the daily chart, the higher time frame, the landscape looked totally different, didn't it?
Completely different. On the daily chart, that entire lower time frame head and shoulders pattern was forming exactly as the price dropped down into a massive bullish order block.
Okay, let's actually define that term physically, because order block gets thrown around a lot in these circles.
Yeah.
What actually makes something a bullish order block?
So, an order block represents the specific footprint where an institution previously originated an enormous buy program.
Okay.
It is typically characterized by the last significant down-close candle right before a massive violent upward surge in price. That down candle is where the banks accumulated their positions against retail selling.
I see.
And because they have billions of dollars committed at that price level, when the market eventually returns to that zone, they will aggressively defend it to protect their original investment.
So the smart money is actually incredibly bullish
Yeah.
because they're sitting right in a massive buy zone.
Yeah,
But they need more sellers to fill their new orders.
exactly.
So they just let the hourly chart paint a head and shoulders. They literally allow the neckline to break just to manufacture retail bears.
That's it. They absorb all that retail selling pressure right at the neckline breakdown, using it to quietly accumulate massive long positions at a deep discount. The retail traders, meanwhile, they're placing their protective buy stops right above the right shoulder and the head of the pattern. So once the banks have accumulated enough volume, they just violently reverse the price upwards.
which triggers what the ICT materials call a turtle soup setup.
Yes. The turtle soup concept is simply the deliberate targeting of those false breakouts. The market maker drives the price rapidly upward to hunt the buy stops resting above the right shoulder, and it leaves the retail shorts completely trapped underwater.
So as an intermediate trader who's, trying to level up,
Mhm.
how do you trade against the cheese? How do you flip the script on head and shoulders like that?
Well, you have to anticipate the trap.
Okay.
If your higher time frame analysis tells you the market is fundamentally bullish, meaning, you are inside a daily or weekly order block, and you see a textbook bearish pattern forming on a 15-minute or an hourly chart, you never join the retail breakout.
You wait.
You patiently wait for the breakdown to occur, you watch the smart money absorb the selling, and then you buy. Your profit target becomes the cluster of retail stop losses sitting on the opposite side of the pattern. Basically, you hunt the hunters.
That is just ruthless.
Mm.
But it completely changes how you view a chart.
It really does.
However, I feel like it requires a massive caveat, which is you have to know with absolute certainty what the higher time frame trend actually is. Because if you're wrong about the macro direction, you're not hunting anyone, you're just catching a falling knife.
That is a very fair point.
So how do we find a time frame that the market makers can't manipulate?
You have to implement a strict top-down approach to find what they call institutional sponsorship.
Institutional sponsorship.
Yeah, it's the willingness of massive entities to step in and dynamically protect a price level. And because of the sheer amount of capital required to actually paint a macro chart, you must begin your analysis on the monthly time frame.
Right, because, a market maker might be able to fake a 15-minute trend line with a few $1,000,000, but it takes hundreds of billions of dollars to fake a monthly candle.
Exactly the point. On a monthly chart, you are looking for the most recent, prominent, down-close candle prior to an upward run, and the most recent up-close candle prior to a downward run.
So those give you your boundaries.
Right. These massive candles define your macro operating range.
Mm.
A monthly down-close candle that results in a huge upward market shift. That isn't a random fluctuation. It is the literal physical footprint of a central bank or mega fund stepping into the market.
Okay, so once you find those massive monthly walls, you step down to the weekly chart to find the intermediate swings, and then you finally drop to the daily chart to frame out where you're actually going to execute a trade.
Exactly.
But the notes also bring in this fascinating external barometer for establishing that macro trend, which is the bond market.
Yes, the bond market is essentially the true compass for currency valuation because currencies are ultimately driven by interest rate yields. The sources specifically highlight the relationship between the 10-year Treasury note and the 30-year Treasury bond. When you see a divergence in these yields, it strongly signals an impending shift in the underlying interest rate environment.
And the example they use is wild. They look at the overnight market panic during the 2016 U.S. election.
Oh, that's a classic example.
I remember watching the futures markets that night. As the election results came in, the Dow futures dropped something like 800 points. The U.S. dollar was just tanking. It looked like pure news-driven chaos. Retail traders were just panic selling everything.
Yeah, to the untrained eye, it was absolute chaos. But the institutional bond market was telling a completely different story.
Right.
During that exact same overnight panic, if you actually analyze the divergence between the 10-year and 30-year yields, it clearly indicated that the underlying interest rate environment was actually pricing in an increase.
And higher interest rates make a currency more attractive to foreign capital, which inevitably drives the value of the dollar up.
Exactly. So the news cycle provided the superficial volatility, right,
Yeah.
and the retail panic, but the institutional bond market dictated the true macro reality.
Wow.
By the time the sun came up the next morning, the market aggressively rejected those overnight lows. The dollar just went on a massive, sustained upward tear.
So if you were only watching the news or the short-term currency charts, you were totally trapped.
Completely, but if you were watching the bond yield, you knew the overnight drop was just a massive liquidity run.
It's incredible. The news is just the weather. The bond market is the gravitational pull.
That's a perfect way to put it.
So let's bring all this down to a highly actionable technique for the day trader, sitting at their desk tomorrow morning.
Sure.
Let's say we've got our top-down bias. We know the macro trend is bullish.
Yeah.
How do we execute without just getting chopped up by the wicks?
So the materials detail a very specific execution strategy utilizing the New York Midnight Open.
Okay, New York Midnight Open.
Yeah. If your top-down analysis confirms a bullish daily bias, standard retail logic might tempt you to buy as soon as you see a big green candle pushing upwards.
Chasing the breakout.
Right. But the institutional approach dictates the exact opposite. You draw a hard horizontal line on your chart at the exact opening price at midnight New York time.
Okay, you mark midnight and then you wait.
You wait. You wait for the price to drop completely below that midnight opening line, usually during the London session or maybe early New York. You are specifically looking for a down close candle to form below the opening price.
Because if the daily trend is truly bullish, that morning drop below the open.
Yeah.
That's the manipulation phase.
Exactly.
It's the market makers dipping into the basement to trip those sell stops and accumulate their long positions at a discount.
You've got it. You are watching for price to trade down into an established higher time frame order block, and when it hits that level, you want to see institutional sponsorship step in to reject lower prices.
And when that sponsorship steps in, it shouldn't be subtle, right? The analogy from the notes is like an elephant stepping into a kiddie pool.
Yes, the water has to violently displace over the edges.
Right. It's like releasing the catch on a massive industrial catapult. There's zero hesitation. The stored energy releases instantly, and the payload violently launches away from the base. If the price just lazily drifts around your level and chops sideways, the catapult wasn't loaded.
Exactly.
But if you see an explosive, dynamic upward thrust away from that low,
That violent displacement is your confirmation. By buying below the midnight open during a structurally bullish environment, you are basically stepping in alongside the smart money right after they've cleared out the retail stops. You are positioning yourself for the true expansion phase of the daily candle.
man, we have covered a tremendous amount of ground today. For you listening, just think about how drastically your perspective has hopefully shifted. You've moved from staring at single isolated charts to actually measuring systemic symmetry using the dollar index and bond market yields.
Yeah, and you've learned to stop trusting diagonal trendline phantoms and instead track the horizontal liquidity pools, the actual resting orders where the market makers do their business.
To ignore the noisy wicks that just represent retail panic and stop hunts. You focus entirely on the solid bodies of the candles for institutional truth.
And you understand that to trade safely, you really must utilize a top-down approach. You have to anchor your bias to the massive monthly and weekly order blocks before you ever attempt to execute near the New York Midnight Open.
At the beginning of our deep dive, we talked about how the diagnostic x-ray of the market feels completely murky and rigged to an intermediate trader. But the truth is, the machine isn't broken. You were just looking for the wrong bones.
Well said.
Once you stop looking for clean, symmetrical retail patterns, and you start looking for the engineered traps and liquidity runs, the true ruthless structure of the market reveals itself.
And really understanding that structure is the only way to survive it.
Which leaves us with one final lingering thought for you to chew on as you load up your charts tomorrow morning. If the financial industry is ultimately a zero-sum game, where for every single winner there must mathematically be a loser, and if the market makers consistently rely on classic retail chart patterns, like the head and shoulders and diagonal trend lines, as highly effective traps to generate the liquidity they need, it raises a very uncomfortable question.
It does. Who really benefits from publishing all those beginner trading textbooks?
Something to think about. That wraps up today's deep dive. Till next time, stay sharp out there.